Welcome, everybody. This is Nadine Mazzola of the Kinder Institute, and I'd like to take care of a little housekeeping first before our presenter, George Kinder, starts the webinar. And I'd just like to test the audio, and I'm going to cue George. And George, can you just say hi to everybody?
Yes, hi, everybody.
And if you were able to hear George, could you just raise your hand? There should be a little icon on your panel. Great. I see a few hands going up. Fantastic, everybody. Thank you. I'm next going to turn the mic over to Roger Wellington, the Executive Director of the Kinder Institute, and he's going to kick us off today. Roger.
Yeah, hi, everyone. And also I'd like to thank you for joining us today for this webinar on risk management and how to avoid client panic forever. I know that many of you, if not all of you, have faced very difficult conversations over the last year from clients who are very concerned about market turbulence. And we prepared this webinar because we think we have a good approach to those sorts of situations that we'd like to share more broadly. The presenter today will be George Kinder, whom many of you may know. He is a longtime contributor to the industry press, a longtime leading thinker in the industry. He's also the founder, of course, of the Kinder Institute of Life Planning. We train financial advisors all over the world in our approach to client engagement. And George, before founding the Institute, was a practicing financial advisor and planner. He did that work for 30-odd years, and during that time really specialized in investment management. So really has a lot of experience having the kinds of conversations with clients that he'll speak about today. So, George, would you like to go ahead?
Great, thanks, Roger. They weren't that odd, but they were. But it was a very rich time period for me. 30 years of work with clients, and it was for me there was an evolution in my thinking as I grew as an advisor, and a time where there was a major shift in how I was approaching clients. And that occurred right around 1986, just before the crash of 87. In the early days, I had been thinking just simply about accumulating assets as rapidly as possible, was big on investing primarily in the stock market. I didn't think a lot about the bond market. And then I began to realize that I had many clients who were thinking about early retirement issues, or were thinking about retirement itself, where the issues for them were quite different from the asset accumulation phase. And so it drew me to shift how I was working with the client, and ultimately it shifted my perspective even on the asset accumulation phase. And so I'm going to talk a bit about that, but what I'd like to do in this talk is show how let's say a way of addressing client fears around banking crises, Great Depressions, market collapses in a wise way can in fact dovetail beautifully with life planning itself to dramatically reduce risk in client portfolios. So the first thing that I want to do is review with you what life planning is and how that impacts risk. So if we go to the first slide here, I'm just going to read it. In life planning, we discover a client's deepest and most profound goals through a process of structured and non-judgmental inquiry. Then, using a mix of professional and advanced relationship skills, we inspire clients to pursue their aspirations, sort through and resolve possible obstacles, create a concrete financial plan, and provide appropriate guidance as clients accomplish their objectives. So that's really a summary of life planning. The conversation that I would have with clients about risk would be in the very first meeting. And if I've shifted slides here now to the evoke process itself, this is the structured client interview process that we train advisors in all over the world, and it's the people who've been trained in this approach become registered life planners on our website for consumers to find. There are 5 phases. You could conceive of them as 5 different interviews and conversations that we have with clients. They could this entire 5-phase process could occur in an hour or less, but more often with significant clients with significant assets and complex problems. Each of these interviews might very easily take place in a separate meeting. So the first meeting is the one I'm going to focus on here, and that's the exploration meeting, because it's in that meeting that we do the work. It's an open-ended meeting, and what we're doing in that meeting is building, deepening, strengthening client trust and building this bond, this relationship between us and them. And we do it primarily by listening. And you'll see here in this next slide the skills that we use. The first 4 skills are all skills that we'll use in the first interview, and even the 5th skill. So we ask and then pause. So we really give the client the space to give the answer. We listen rather than solving. We empathize rather than shutting down or avoiding the emotions that a client might bring up. We endorse what a client's experience and client's passions and purposes rather than judging them. And in the second meeting, primarily, but also some in the first meeting, we inspire rather than squelch the dreams. So if you recall from the definition of life planning, what we're really looking to do is to build upon those dreams. But it's in the first meeting that I have that conversation, because the conversation about risk that we're going to get to in a few minutes, the conversation that involves actually looking at historic performance of assets and looks at the Great Depression and the crash of 1929. By the way, I just want you all to know that I chose this day on purpose to give this talk. October 29th, 1929 is known as Black Tuesday, and it was the greatest one-day crash that had been seen up until the crashes in 1987. So it's an historic day, 80 years on now from that time. So moving on to the next slide, what we're really talking about here is reducing risk, and one of the things that happens, obviously it's a very emotional experience for clients seeing their portfolio steadily drawing down. And I think it was it March 8th, the low point of this particular market. And I remember that day very well because all of my animal spirits were saying this is the day to invest, because it felt like there was so much panic that was occurring in the market at the time. But the conversations, unfortunately, the conversations that many advisors were having with clients at that time, as they were trying to keep the clients from pulling assets out of the market at the worst moment, of course not knowing that it would be the very worst moment. None of us could possibly know that. But the question that might be asked, and I think probably was frequently asked, which would make you feel worse, to see your portfolio erode further, or missing the next upturn, missing an upturn? And from the standpoint of the risk model, the risk work that I do and have done with clients and did with clients for a couple of decades, this is really the wrong question. And it is a place that if you do this work that I'm going to describe of interweaving life planning with a 4% solution, you'll never have this question arise. You'll never have this argument arise. It'll be there's a completely different frame of reference that we're going to go to, because the frame of reference here in this question And what drives the panic, the anxiety, the uncertainty is that the frame of reference is on the portfolio value. And one of the things that we all know and that we should have, I think, wisdom around rather than panic and emotion around is that portfolio values are never stable. Portfolio values are always in flux. And with perhaps perhaps you could argue that inflation-protected bonds are stable, but you certainly couldn't argue that bonds are stable given the movements of inflation or deflation in economic environments. So portfolio values are never stable, and yet that's the focus for so many of our conversations. I think it's an inappropriate focus. So what we're going to learn today and look at today is how we can shift that focus from to a focus on income or distribution from a portfolio, and how we can do that even for someone who is 20 or 30 years away from that income or distribution. But fundamentally, if our focus is on something that is unstable, like portfolio values, it's really a setup for an unstable client relationship and an unstable client and an unstable client relationship to risk. So it really is the wrong conversation. And now moving to the next slide, we're going to talk for a moment about risk measurement tools, and here I'm going to put them down a little bit. I do want to say that I think they have a real use. I think they have a real value, but that it's much smaller than what we think about, because the point is not to measure a client's risk profile, but to reduce a client's risk profile. And that's what we do in life planning, and that's what the added solution of the 4% solution does as well. So once again, the point in our advisory work should not be to measure a client's risk profile, but to reduce the client's risk profile. In fact, to reduce it enough that what we know makes the greatest economic sense for a client is something that the client can hear and is eager and is inspired to execute, to make happen, so that reason governs the decisions around money rather than emotions governing the relationship with money. So here, in terms of traditional risk measurements, why they fail, well, it asks clients to predict how they'll feel in the future, and we've all seen how that works, and we all know that in a moment of intense market collapse, we can feel very differently from how we feel right now. It ignores the greater intensity of feelings as markets collapse. It discounts the power of client-advisor trust. One of the things that has not been measured, but I suspect very strongly will prove to be the case, I feel absolutely confident that it will be the case, is that if you were to give a client a risk profile measurement, if you were to do one of these tests prior to having a conversation with them, they're just going to come in for the first conversation, they've never met you before, you're going to get one risk profile. If after meeting you and having a conversation, they take it again, I think you're going to have a different risk profile. And if after you've really done the work, and particularly the work of the 4% solution and the work of life planning, which is all about creating a much higher degree of trust, once again, I think you're going to have a very different client risk profile. So, so that's the client trust piece. The final piece here is that the risk management tools really don't measure the greatest risk of all. And the greatest risk of all to a portfolio is the client walks away from the portfolio, that they basically withdraw all of their money. They put it all in whatever they think is safest, whatever it might be, or whatever they think is best for them. And they're acting not from a place of wisdom, but coming out of a place of fear. So that whether they go to gold or they go to the bank or whatever they do, the greatest risk of all their portfolio is walking away. And it's a particular risk in relation to the 4% solution. So we're going to show that in just a moment. Next slide. So the general point here about risk is that advisors who build the greatest client trust, and I'm going to jump down to the bottom here, systematically reduce risk in the client's portfolio and in the client's life. Advisors who gear their performance toward the client's most profound purposes systematically reduce risk in the client's portfolio and their life. And advisors who design portfolio solutions around the 4% solution systematically reduce risk in the client's portfolio and their life. Once again, if you've built great client trust, the client is much less likely to act in a panic and make inappropriate decisions in a market crisis. In addition, if you've really geared their performance not toward the portfolio value, which is unstable, but you've geared the performance of you as a team, you as an advisor, toward the client's most profound purposes. So you're really delivering what it is, how it is the client wants to live, which is what life planning is all about. Once again, you're going to systematically reduce risk in the client portfolio because their focus is not going to be on that unstable nature of the portfolio's movements up and down, but rather on the actual delivery that is very stable of authenticity, integrity, whatever the client's purposes in life really are. So these are terrific things. Let's see here. We're going to go to the 4% solution and define it here for you. The 4% solution is the maximum annual distribution to a client from a diversified portfolio designed to last forever, at least for a very long time, till the client passes away. And often I would design it to last forever, based on the optimal historical balance between stocks, bonds, and other asset classes. So let me describe for a moment how I arrived at the 4% solution myself, and then also mention some terrific figures today who are involved with designing and helping all of us design portfolios around the 4% solution. The man who comes to mind foremost is Bill Bengen, William Bengen, and I'd encourage you to pick up his book, which is put out by the FPA Press. I'm sorry, I don't have the name of the book here, but I think it's the only book he did, produced by the FPA Press. He's written numerous articles for the FPA, for the Journal of Financial Planning, and really has been the pioneer in describing the 4% solution. Now, I was working with the solution long before Bill did his first book, and so there certainly were others of us in the marketplace who knew these ideas. But what Bill did was he put it down in a form that anyone can pick up and learn from in a very easy but also professorial kind of way. Extremely helpful. What I did, as I said, in 1986, I began to rethink how it was that I was investing with clients and thinking about serving the needs of my clients who had early retirement or retirement on their minds. And I had access at that time to Ibbitson's stock market, bond market data. And that data, as many of you know, goes back to 1926. So I had exactly 60 years, it might have been actually 59 years, but 59 or 60 years worth of data comparing stock market behavior with bond behavior, with I think it was with bond behavior and then with treasury bill behavior. And so I went back and actually created spreadsheets with that material. And I would encourage you to read Bill's book. It's a shorthand for all of this. But I would also encourage you to get the data if you like spreadsheets and run these questions yourself, because Bill has a number of scenarios that he creates and judges from. But I would be thinking how is this the way I would frame it? And my particular frame was a little bit different from the traditional financial planner's frame. Traditional financial planner is concerned frequently, quite obviously, with inflation, so you'll factor in inflation, and the 4% solution would be an inflation-adjusted solution, and Bill has examples of this. One of the ways that I was very intrigued with this work was how to create the 4% solution so that you could increase the amount that a client was receiving at every market peak. And so that was the design that I would use in my spreadsheets. I did not pay as much attention to inflation, although I had, well, gosh, we probably ran 20 or 30 different scenarios, again, going back all the way to through the Great Depression, but also through the Rust Belt era of the 70s. And so the portfolios I was aiming to create were portfolios where the client could increase their distribution at any market peak. The 4% solution is based on the last market peak. I just got a note here saying Bengen's, I don't know whether this is his article or his book, but you can look up, Google William Bengen, and it's called Conserving Client Portfolios During Retirement. So I was passionate about figuring out how to do this, how to deliver the highest distribution amount, and curious about and determined to figure out what would be a stable portfolio relationship between stocks and bonds. And I came up pretty close to the 60-40 split that we've seen in the press for forever between stocks and bonds. I think that my research showed you could go anywhere from 60 to 70% in equities. And I believe recent studies have shown, and I think some of Bill's research has shown this, that you could go as low as 50% on equities and as high as 75%. Now, the interesting thing nowadays, of course, is that we've got a lot more asset categories than the three that Ibbotson's data takes for us back to 1926. So my own personal judgment was that we could probably go up to, it's probably really the 5% solution, but I would call it the 4% solution for conservative sake. But with all these additional asset classes, the risk profile, probably you're going to get a 5% solution, and I believe Bill's done some study with that that indicates that in fact that's true, that it's closer to 5%. You also have Jonathan Guyton is another name in this field, and I think that Bill's website also talks about other people who've done some wonderful studies in this regard. So the conversation that I would have with a client would come at the end, as I said, of the exploration meeting, and it's an interesting time. If you remember, evoke starts with the E for exploration. It's the meeting where you really just are listening to the client and asking very open-ended questions. The primary question you ask is, why have you come in to see me? Why are you here? And then after you've asked that question, there's really just one other question that we primarily focus on, and we use that question again and again. And the question is, anything else? Anything else? Anything else? And then we pause and we listen. And what happens when you are doing really high quality listening to a client, working with empathy, and really interested in who the client is and what their issues are, typically most clients will talk a lot and will reveal virtually everything that they feel is important to address, both financially and personally. And it's a very rich meeting, and the client, the level of client trust just goes sky high. There's a sense of a deep, trusting relationship that is being delivered. But sometimes, of course, as you're doing this, you're wondering, and the client may be wondering as well. I think the client's wondering it less than you might be. Well, what does this have to do with finance? What does it have to do with a financial plan? What does it have to do with financial advice? And the answer, of course, is everything. It has everything to do with financial advice, because without really aligning with who the client is, you're not going to deliver great advice, because it's not going to be tailored to who they are. But regardless of that, just honoring that uncertainty that is there, what I would do at the end of every exploration meeting, I would save a half hour at a minimum. Sometimes it would be 45 minutes, sometimes it would be an hour. But let's say it's a half hour, and in my mind, I'd think of it as bells and whistles. What I want to do is surprise and delight the client with my knowledge of investments and how they work, and show them that I can do this work as well or better than anybody in the business, and that I really know what I'm talking about, and I'm really going to also solve some of their major fears as well. So I bring out the charts and the graphs at that time, and the primary chart that I would show them would be a chart very similar to this one that you're seeing on your screens, which is a chart that in a logarithmic scale shares the stock market history over the last 108, 109 years now. So what's obvious from this scale is that there's, I mean, it just stands out like a sore thumb. The collapse that occurred from 1929 to 1932. From top to bottom, it was close to 90%. I think it was 89.2% from the very top measurement on the day that the collapse began to the very bottom measurement three years later. That's a huge collapse. And I want to bring clients directly to that experience and to that moment, because how else are we going to deal with what their real panic is, which is, what if everything falls apart? What if we have the worst case scenario you could imagine? What would occur then? And we want to bring that uncertainty and that fear to rest, so that the client never has to ask it again. So here we are. It's a 90% collapse, let's say, and let's say the client has an urgent need to take out 10% of the portfolio as of the October 29, 1929 value. So, of course, they do that. They need to do that in 1932, and what happens? They've got nothing left. They've lost everything. So I want to bring that up and talk to them about it and say, so if you just invest in stocks, here's something that might occur. And then I'll bring them back, and I'll bring them back to the 4% solution at that point. And I'll say that, in fact, if you look at 1973, 1974, and you'll see that's the period of time. It's actually from 1969 to 1982. You'll see a genuine flattening of the market, where the market pretty much peaked again and again around 1,000, and then took off in August of 1982. But it had a terrible collapse in 73, 74. Much worse. I know some of the listeners today are from across the puddle, as we call it, over in Great Britain, and it was even worse over there. It was in the 70% range, whereas here it was in, again, from the very top moment on the highest day of 73 to the very bottom moment in December of 74, and it was a double bottom. There was a bottom in October, and then it came back in December. You had a collapse of close to 50%. Again, it was around 49.2%. But what most people don't realize is that the Great Depression collapse and the collapse of 73, 74 were very, very close in real terms, and they were almost identical. You had much worse unemployment in the 30s than you had in the in the 70s, but of course we had the worst unemployment in the 70s that we'd had since the Great Depression by far. The difference, what made them very similar, was that from 1929 to 1932, we had the highest level of deflation in America that we've seen in the 20th century, whereas in the period from 1969 to 1982 or so, we had the highest period of inflation in America. So it turns out if you adjust the market collapses in 1929 for deflation, or inflation but in reverse, and you likewise adjust the market collapse in 73, 74 for inflation, what happens is that they end up being just about identical market collapses. In real terms, they were, you lost about 2/3 of your money. It was close 65, 66, 67%. So very, very similar market collapses. I would show that to the clients. So I'd say what we have here is we've got two examples of really worst-case scenarios, what could happen. And clearly in nominal terms, the 29 one is the most terrifying of all. And then I'd talk about how the collapse in 1929, I'd actually have a chart that went back to 1800 and show them that although there were what they called market panics in those days, there was never a market collapse that compared with the 1929 collapse. So I could say this is really the worst market we've seen in American history. And in fact, if you take kind of the developed world, you have to go back to the Great Plague and the fire of London in the 17th century to come up with something as disastrous as or more disastrous than the Great Depression. So if we can create something that would tolerate the Great Depression, how would that feel to you? And of course, the clients just, they're delighted that I'm addressing it, and I'm going to come out with something with immense confidence that, in fact, you don't have to worry here. So that's what the 4% solution is about. If you have an asset structure of, let's say, 60 to 70% stocks, 30 to 40% bonds, and nowadays you're going to put in more, some alternatives. You're going to have some of the riskier bonds in there. Certainly you're going to have emerging markets, international stocks, and all the rest, and all of that's going to help reduce the portfolio volatility. But the best results historically came with using the most conservative of bonds, treasury bills, and the highest quality of bonds. So you'd want to have a real leavening of the portfolio there. Remember that the use of bonds here is primarily to enable the greater investment in the stock market, which is, of course, investing in the creativity of the human imagination. It's the creativity in action, and it's what it drives a human progress, clearly. And so we want to invest as much in that as possible because that's where the greatest growth is going to come. How can we do that while reducing risk? So that's what really the 4% solution is about. So when it comes to a market crisis, comes to March 8th of 2009, March 8th of 2009, and the client comes in and they're terrified because of the portfolio, I would look them in the eye, and whether this occurred in 1987 or the collapses that occurred in the 90s and early 2000s, and I'd say, you have lost nothing. That's a bold statement. But you have lost nothing. And they go, well, what do you mean? And I'd say, remember what we're going for is the degree that you can take income distributions from your portfolio. That hasn't diminished. I know the stock market has fallen 50%. I know your portfolio, it's a balanced portfolio, and it's fallen perhaps a little over 30%. But you know what? You have lost no ability to draw on that portfolio at all. The 4% solution is based on the last market peak. So don't worry. Go home. Yeah, I mean, if you are worried, I mean, I'll tell you frankly, whenever there's a market crisis, I'll reduce some of my discretionary spending. And the more worried I am, the more I look at that. But I don't worry about my portfolio because I know that I can get delivered on it at any time, that it would have to be something worse than the Great Depression. And if I'm adjusting my discretionary spending, it'd have to be something far worse than the Great Depression to impact my real portfolio value, not which is the value of the distributions that I'm looking at. So what's happening here, it's really quite extraordinary. You're shifting, you're trading real knowledge. Here you know, when you're dealing with portfolios, you've got the real uncertainty of principle, and that's a very unstable relationship, a very unstable investment. Let's see, here we go. You're trading a certainty of knowledge because you know what that distribution amount can be with enormous certainty based on the worst market crises that we've ever seen. Deflationary period, inflationary period. You can mix in Monte Carlos with this as well. Everybody comes up with the same result. And so you're trading. You know, do you want to base your relationship with the client on the uncertainty of the principal value, of the portfolio value, or of the certainty and the stability of the distribution amount? And that's what you're doing here. And that, you can see, I think, pretty easily that that's going to stabilize the client's relationship to their assets. And you're not going to lose them. They're not going to make foolish decisions. Remember, if they take money out March 8th, that's real money lost because they're going to then get back in. I mean, you don't know whether when you're taking it out, and if you get back in at a higher level than March 8th, that means you no longer, the 4% solution no longer works. You have to adjust the 4% solution down from the last market peak. So let's see if there's anything else I have to say here before we move on to a summary and the opportunity for question and answer. Yeah, I think I've covered pretty much everything I want to cover here. Let's go on to the next slide. So the 4% solution, we draw 4% of the portfolio annually. This is a summary here. It's if the income is maintained regardless of the market cycle. It's based on 80 years of data. So you've got just tremendous sense of confidence in that data, in that time frame, in that experience. And of course, now we've got all these new and exotic vehicles that can, again, because of correlation, impacts can reduce volatility but add rate of return. And finally, the focus is on the income stream again and again, not the net worth. The other thing here about focusing on the income stream is you're focusing on the dream. You know, you're focusing on the life plan. This is where the focus ought to be in financial planning. Financial planning should be about the person's life, the couple's life, the family's life. And that's what an income stream is about. A portfolio value is not about the life. It's this very uncertain thing that can vary tremendously over even very short periods of time. And then finally here, the 4% conversation. It's delivered once again at the end of the exploration meeting, and that is a very key place for it because the whole exploration meeting is about deepening trust, reducing anxiety, building confidence in the relationship, and this is kind of the set piece at the end of that conversation, and it's so tied in tightly and intellectually in a powerful way with details, figures, charts, dollars and cents, pounds and pence, way that the client has a tremendous sense of relief and a sense of confidence that you're going to be there, that you can handle. If you, the advisor, can handle the Great Depression for them, why should they fear what's happening in the market? So I'm going to trust what you have to say, and I'm going to trust you intellectually, and I'm going to allow you to lessen my feelings emotionally. So it directs planning toward funding the key life goals. It's oriented toward freedom, not toward acquisition, and it maintains ease when the markets crater. And I think the only other thing I might add here is because you've explicitly addressed the Great Depression, it's the worst case scenario. It's the elephant in the room that the client's almost afraid to ask and assumes that you have no control over. So what a powerful thing for them to hear, that in fact you do have tremendous control over it. They trust you, and they know you've got a handle on things. I want to just acknowledge that that this will work for most of your clients, by far the majority of your clients. I mentioned in the early days of my investment advice for clients, my focus was on more asset acquisition. I was a young man. I was working with young clients. But even there, what I've realized is I've gone back and thought about those times for myself. Even when I had the first $20,000 that I'd saved up for myself, I had an escape fantasy with those $20,000 if I wanted to live freely, if I got tired of the work I was doing. And that escape fantasy is under tremendous jeopardy if you base your portfolio, again, your focus is on the portfolio value, because one never knows when the next great market crash will arise. But if you base it on, if you base your whole understanding of your net worth and your asset value on the 4% solution, then it's not at risk. So even with young clients, I would play to the escape fantasy and to the 4% solution, and as a way to reduce risk in the portfolio. They still may be the ones that are invested 75 or even 80% in the market, but with the 4% solution, you might be able to hold them back from the 100% that then might be at great jeopardy. And then, so I think that's it for my part of the conversation. I'm eager to hear your comments or your thoughts. Nadine or Roger, I don't know how you've set this up, whether they're going to come in written form or people are actually going to get on the speak on the telephone. But I'd love to take questions or hear comments at this point in the conversation.
Hi, George. This is Nadine. Hi, everybody. We do have a couple questions, George, and what I'd love to do, if possible, is unmute people and let them ask their question themselves. And so let me just see here. Dawn, we're going to unmute you, and some people may not have a microphone at their desk and whatnot, and we may just have to read their question. Dawn, go ahead if you have a microphone. Okay, it looks like Dawn doesn't have a microphone, so I'm going to read his question here. And Don asks, what specific asset allocation do you recommend for U.S. versus foreign securities?
Yeah, and Don, it's been 8 or 9 years since I've actually directed client portfolios, and so I've pulled back a little bit from that focus. And there's I think there's an argument for matching the world, how the world portfolio might look, and if you're investing in the whole world. And at the same time, there's an argument for being centered on one's own specific currency. So what I would do is I would engage in that view of if it's U.S. based. I know there are people here on the line who are from the UK. So whether it's U.S. or UK, and whether the UK also, they're looking possibly at the euro as well or the dollar as well. In the U.S., I would take the world position that we hold in terms of equity value, in terms of the whole world, and I would diminish it a bit, because when the U.S. market is really going great guns, corporations that would tolerate that enormous difference between our markets and their markets. So I'm afraid that's the best. I don't have a specific figure that I can give you, but that's how I would work with that dilemma.
Okay, and next question here is from Matt. And Matt, I'm going to unmute you, and please go ahead, Matt, if you have a microphone. Okay, it looks like Matt doesn't have a microphone either. And Matt was asking, what do you mean when you say 4% is based on the last market peak?
Yeah, the distribution amount that you can take. So if your portfolio value at the last market peak was $1 million, then you'd be able to take out $40,000 per year, even if the stock market value fell in half or fell as much as the Great Depression, which was 90% over 3 years. And the reason for that is that you've got a balanced portfolio, and so whatever else you're invested in is, in fact, leavening that overall collapse. So, for instance, in the Great Depression, in fact, your bonds were increasing in real value, but if you had 40% in bonds, let's say, and 60% in stocks, your net portfolio collapse was 90% of the 60% in equities is 54%. But then your bond portfolio is probably increasing in value because of deflation. So you lost probably a fair amount less than 50% in the Great Depression. So a 4% withdrawal rate is not, or distribution rate from your portfolio is not going to jeopardize that portfolio.
And we have another question from Mike, which I think relates to what you just were speaking about. I thought the 4% solution was set annually. You mentioned it is set at the last market peak. Well,
again, you talk to different people and how they've worked with it. I wouldn't be surprised if Bill's approach is setting annually. I don't know exactly how he sets it. The way that I always worked was from the last market peak. It felt like it was more exciting for the client that way. They felt they could really then gain from market increases, which most people believe in and want to bet on, and so that would be how I would work. It may be that there's a point in one's aging process where inflation becomes more important, and you might want to look at the 4% solution design based then on an inflationary scenario. And what I was suggesting was running spreadsheets yourself, getting Bill Bengen's work and looking at how he's run many different scenarios, looking at those different scenarios and understanding them. Jonathan Guyton has a scenario or two that he's described. And then, as I say, there's another fellow that Bill references who's also run, I think, dozens of examples. Best thing is to run your own in addition to what you're seeing the experts do. If you're inclined towards spreadsheets or you have someone in the office who can do that kind of work.
And we have another question from Elizabeth. Elizabeth, I'm going to unmute you if you'd care to ask your question. And it looks like we're striking out on the microphones today. Elizabeth was asking that previous to today, I had understood that the 4% solution involved maintaining a 2-year stash in bonds and fixed income to cover the future client income needs in a down market. Is that still correct?
The way that I would work with it and the way I think that most people work with it is just simply a balanced portfolio between stocks and bonds. That bond portfolio, again, the historic studies imply or suggest that the bond portfolio is actually best with the very safest quality bonds, and so you have an emphasis on the Treasury bills, on just exactly the kind of investments you'd want for that 2 years of cash needs if there's a market collapse. So we would certainly be taking assets, we'd certainly be using those assets and drawing down those assets as part of the distribution process if, in fact, the client was in the distribution phase of their life. But once again, this is something that you can see studies on, and there are many different ways to approach the 4% solution. And I encourage those of you who are mathematically inclined or spreadsheet inclined to run the studies in your own way with what you feel most comfortable, how you would feel most comfortable engaging with a client. The 2-year safety mechanism is a very common one in financial planning, in the financial planning community, and if that's how you feel most comfortable, I would certainly work with that as part of the overall portfolio.
And Robert has a question. How do I start attracting the clients who will work with the 4% conversation, exploration meeting, etc.? And perhaps you might frame the exploration meeting for those who might not be familiar with it.
Yeah, I mean, I think the best way to attract clients is really to proclaim your work, at least within your firm and inside yourself, as being the work of life planning. And so to do that, it means really mastering the life planning process. And of course, I highly recommend the workshops that we give. We give a really deep and profound professional training in becoming a life planner so that it really is embodied inside yourself. And as you do that, I mean, one of the things that we talk about in every workshop is the marketing aspect of this, and how do you attract consumers to this overall approach. And it's a very exciting thing, because what you're really doing, the most exciting thing, is not simply this reduction of risk, but in life planning, we're really delivering the client to the goals that they most profoundly want in their life. That is the most amazing experience in a financial advisor's profession. It's invigorating, exciting, dramatic, fun for both the advisor and the client. So the way to do this is to learn how to do that. You could certainly start with my books, The 7 Stages of Money Maturity, and then the Lighting the Torch book. But I think because this is an experiential process, how to listen, how to empathize, and then how to inspire, the real art of inspiration. We actually call that lighting the torch. It's a moment in a conversation. That's in the second meeting, the V for vision meeting, and I encourage you to do this experientially. So you've experienced it for yourself. If you've lived your own life plan, then you can inspire the clients to live it as well. And the life planning, building a life planning practice makes the 4% solution conversation extremely easy, because you're now basing your whole client engagement upon the delivery of the client's life. And that's a conversation ultimately about income and distributions, and not ultimately about portfolio value.
Ronald had a question, I think wanted to confirm, as an example, currently, I think he's referring back to the 4% solution in the market peak. As an example, currently the 4% would be the 4% from the market peak in 2008 based on the whole portfolio value at 2008?
Absolutely, that's right. And that's why, when the client, we hit March 8th of 2009, and I look them in the eye and I tell them, you've not lost anything. You can still withdraw income at the level of 4% per year, or just take distributions from your portfolio at the level of 4% per year based on the last market peak. And that's a terrific thing to be able to say to the client. And again, really builds the client's confidence, as well as it's a thing that if you understand, if you've run the data, you've read Bill's book, you've run the Ibbotson data yourself, you'll gain confidence. You'll know this system really works. And then you've got the confidence So it's similar to living your life plan. When you live your life plan, you have the confidence to deliver for your clients their life plan. In a similar way, if you've really studied this work, you've got the confidence to deliver it.
And Dawn has another question. Does the 4% solution assume a minimum 50% exposure to common stocks? What about metals?
Yeah, I mean, but basically, again, we're talking details of numbers, and there are a range of opinions here. But the studies that I've seen indicate somewhere between 50 and 75% is in common stocks. Now, that might include some common stocks. Certainly would include some common stocks of commodities. So you've got some commodities in there. It might include some of the alternative investments that people that are very popular right now. But the studies that go back to 1926 don't include all of those more exotic vehicles, because we don't have the kind of data that Ibbotson had on stocks and bonds. So we have to run shorter-term data on for instance, on commodities. So how you put commodities into the portfolio should be based on the longest term history you've got of commodity shift in value and the returns that they deliver. Personally, I have less than 5% in commodities in my portfolio and in portfolios that I recommend to clients. So that will certainly help in times like now. But we know that there's also a tracking of commodities with inflation that is not as productive as the enormous creative ingenuity of the human spirit that's represented in the stock market.
Colin had a question and wanted to confirm that he was understanding this correctly. He writes, Bengen, Guyton, Kitex, apply the 4% to the first year of withdrawal and then adjust up by inflation each year. Your method does not automatically apply an inflation adjustment. Instead, withdrawal increases are a result of increasing markets and portfolio values. Down markets leave you with a withdrawal based on the last peak. The next increase comes after a new portfolio high?
That's the way I like to do it. I can imagine situations where clients, where you want to have the inflation piece put in there, where a client, you know, if you think about early retirement versus when you're, say, in your mid-80s and you're traveling a lot less, you're a lot less engaged in the world, you're not going out to eat as much, there's perhaps not as much entertainment, you know, where you're spending less, I can imagine adjusting it just for inflation. But if I'm working with someone in early retirement, someone who has flexibility in their life, I would want, personally, how I intend to, as I move into that phase myself, I know that I can adjust my discretionary spending down somewhat, so I'm willing to do that when when there's a terrible market collapse. And I'd rather be betting on that next market rise and have that additional income to come in at the next market peak. So I much prefer that. I'm surprised that, I mean, I honestly don't know whether there are studies that other people have done on this. Next time I talk with Bill Bengen, I'll recommend that he makes this study, or Jonathan. But if you can get the Ibbotson data yourself, I know many of you have access to that, and I think Bill Bengen has a lot of data on his site. I highly recommend that you look at that as an alternative. You could always, to clients, you could present the alternative that they either work with the next market peak or they work with inflation. You could give them those two alternatives and base your portfolio distributions on their choice. So it's not that you have to do it one way or another. The most important thing is that it matches the client's life, their life plan, how they want to live.
And Eric has two questions. Any thoughts on the current fear of a future dollar collapse? And how would you talk about the fear as it relates to the 4% solution?
Yeah, that's a very good question. Was that Eric?
Was.
Yeah, and I don't remember if Eric asked the earlier question about the balance between foreign stocks and U.S. stocks. But here's a place where I might want to carry foreign stocks in foreign denominations rather than in dollar-denominated currency. I think it's all speculation. All of it is all speculation, and I think it's a reasonable one. I have absolutely no idea. I see ways that the U.S. could return to growth in a much more rapid way than we've ever imagined in the past. One of the things that life planning actually does, if you think about it in a broad context, in the context of how Adam Smith thinks about economics and animal spirits, life planning, when you're releasing clients to actually live their dreams, there's tremendous vitality that's released. So I think that as we move toward life planning as something that is done for every client, and not only for every client as we learn how to deliver this process, and I'm passionate about doing this, to working class people as well as people who have significant resources, you're going to see an uptick in economic activity that's driven just simply by vitality in people's lives. That would strengthen the dollar tremendously. So I'm an agnostic on it. I can see the rise of the Chinese as much as anyone can, and the entrepreneurial spirit that is over there right now, the release into freedom that they're feeling. Again, I think that we could see that same release happening here in a different way in a much more developed economy by really delivering life planning to everybody in the developed world. So, but if you're thinking along those lines that Eric is describing about the possibility of a dollar collapse, I'd want to have my portfolio adjusted so that it has equities invested perhaps more in the currencies of other countries. I mean, another way, of course, is to have some currency investments as well that are more like bonds, and that's perfectly possible as well. So I think that's very smart thinking to be doing that.
And Matt had a question. What market do you use to track the peak? S&P 500?
You know, that again, I'm old school because I started my practice. I started investing in actually selling short in 1973. Started my investing career in 72, 73, 74. So I always followed the Dow. I think now the S&P is a perfectly reasonable index to follow and to judge your portfolio by.
And is there anybody else who had a question but had their hand raised and we haven't gotten to you yet? Or I think we're coming to the end here. I don't have any more questions. I think, George, if you'd like to wrap it up, we will call it a day.
All right, no, just thank you very much. It's terrific. I usually talk about life planning these days. It's a fantastic experience for me to come back and really address some of the really fundamental issues of investment management and how to interweave that with a terrific life planning practice. I hope to see all of you soon at one of our workshops, one of our trainings, or at the Kinder Institute conference that we're going to be having in March here in New England. My best to everybody. Thank you so much for coming.
Thank you, George. Thank you, everybody, for attending.